Good afternoon, and welcome to our webinar, Making Sense of Your Stock Options. At TM Wealth Management, we're all about education, so we wanted to share today. We've been getting a lot of questions. It seems to be an increasing preferred compensation mechanism for a lot of companies. So we just wanted to provide today a general overview of things to consider with company stock options. So really making sense of your stock options. So as we get started today, the first thing is we want to make sure we have our disclosure. This is designed as education. We're going to talk about some tax elements today, but really encourage you to reach out to your tax professionals to understand how these specific elements might apply to you. We're going to take a general overview of things today, but feel free to reach out to us and your other professionals to better understand how these specific topics might apply to you. And just to give you a brief overview about me, so I started my career on Wall Street, working Goldman Sachs and Deutsche Bank, and really learned two really important things. One was that investment banking is not conducive to a family. I have 4 kids and really wanted to spend more time with them than at work. And so that was one key learning element. And the second thing that I learned about investment banking, at least for me, is it was very transactional. And I really wanted to develop relationships and have a long-term impact on individuals and families' lives. So transitioning to wealth management was an easy transition because it really fulfilled me in terms of being able to help families and individuals make good financial decisions. And so as I looked at structuring our wealth management practice, there were 4 key principles that were important to me. Number one is being independent. A lot of times when I worked for Deutsche Bank and Goldman Sachs, those are great financial institutions. They had a lot of hands and a lot of different elements of the financial services. And a lot of times the products they were recommending, they also created. And so I felt that that created a bit of a conflict of interest. And so in structuring TM Wealth Management, we want to make sure we were independent. We have no home office, no sales quotas. It really is working for the individual client. Additionally, boutique, right? The banks that I worked for are referred to as bulge bracket banks. They were very large, had tremendous capabilities and great institutions. But for me, I wanted to make sure that we had the ability to spend the time with each individual client, and we weren't worried about the volume of what we did, more focused on the quality of what we did. And third was wealth management. All too often, I saw financial advisors only focusing on the assets that they were managing, that they were getting paid on, to be frank. And for me, there's more that goes into an individual and family's financial picture than just their investments. So things like estate planning, tax planning, insurance, business interests, all of financial planning and investments, of course. And then lastly was the structure under which, the regulatory structure under which we would operate. We chose to be a registered investment advisor under the Securities and Exchange Commission, which provides us the legal obligation to do what's in our client's best interest. So we function as a fiduciary, and that was really important to us. So that's our firm. That's a little bit about us. And so what's kind of driving a lot of the interest is everybody was aware of the largest IPO in the history of the markets with SpaceX. And what that did is it heightened the impact of equity, of ownership, and of options, right? So the SpaceX IPO created the world's first trillionaire. I don't think he's there yet anymore, but just given the price of some of the companies he does own, it created more than 4,400 employee millionaires and created nearly 4,000 individuals with holdings worth at least $100 million. So equity or ownership or stock options can have a significant impact on an individual's cash flow, on their wealth, and to understand how these operate, it's really important because there's a lot of decisions that go into these, and sometimes people aren't fully aware of what the benefits are. And so today what we want to do is just go over in a high level what might be some of the options, some of the equity compensation that you get, and how they might play into your overall financial picture. So one of the things that most people are familiar with are RSUs, or restricted stock units. This is a compensation vehicle that companies provide, and there is usually a vesting schedule in terms of when these units actually become stock holdings. And they're usually granted at a specific price. And so it can sometimes get confusing because these are stock units, not stock options. And so they are stock that you can ultimately receive once you reach that vesting period, or the period of time you have to wait before you can receive those specific stock units. RSAs are stock awards. The big difference there is you are actually receiving the stock at that point. Now, there may be a vesting period associated with restricted stock awards, but at that point, you're receiving that stock, and that can have different tax implications. There's non-qualified stock options and incentive stock options. And I think the big thing, and we'll talk a little bit more about those specifically, those aren't quite as prevalent as RSUs or RSAs, but they are out there. And that was a big element of what happened in the stock or the SpaceX IPO. But the big difference to think about between the options or units and awards is RSUs don't require any cash outlay. And when they vest, you automatically receive the shares or the cash value associated with that. They always have intrinsic value as long as the stock is worth something. So it's, and I don't want to confuse people, there is a tax withholding or tax element to RSUs, but you don't have to actually exercise, and we'll talk a little bit about that when we get to the options, you don't have to actually exercise RSUs. ISOs and NQSOs are stock options, and they give the recipient, usually the employee, the option to purchase the stock at a set price. If the stock price drops below that strike price, these options now become underwater and worthless for all intents and purposes financially at that point, different than the stock award. So if you think about the RSUs, as long as the stock price has value, your RSUs have value. So if they get awarded to you at $75, the company struggles and it goes down to $5, you still have $5 of value. Versus ISO and QSOs, they are options. So if it's granted or you have a stock option to buy shares at $100 and the stock goes down to $50, you would never exercise those options because it gives you the ability, the right to buy the shares at $100. But if you can go on the open market and buy those for $50, why would you buy them at a higher price? So the key difference between these two different units, awards, or options is really that the RSUs, you're receiving the stock. It may take time through a vesting schedule to get them, to get the actual financial benefit. The options, ISOs and NQSOs, give you the option to buy them. And there is a cash outlay for exercising an option. So that's the key difference as you think about what you've received. And really one of the key takeaways that I want to emphasize today, if you are receiving any of these, is really get a copy of the option or RSU document. There should be something that your HR department or your company has that says, hey, here's how we have structured our RSUs, ISOs, and QSOs with the vesting schedule and timing and all the different elements associated with that. So let's talk a little bit about the RSUs versus the RSAs, right? So RSUs are issued at vesting. So this is what I was talking about, the difference between the RSUs and RSAs. There's a vesting schedule with the RSUs. RSAs, those shares are issued when they are granted to you. And that has a tax impact to them. So the taxable income for RSUs is its ordinary income tax at the vesting period. So if it's a 3-year vesting period, you have to wait 3 years before you can actually receive those shares. And the tax impact happens at vesting. RSUs is, again, ordinary income, and it is usually at grant, but it could be at vesting. And there's this element of the tax code called an 83B filing. We'll talk briefly about that. That has some different impact on the taxability or the tax liability for RSAs. Capital gains. So you can be subject with RSUs and RSAs for capital gain tax above your basis. Again, this is depending on your hold period. We're going to go specifically through an RSU tax scenario just so we can better understand where and when you get taxed. 83B election. We'll talk a little about what that is, but RSUs don't have that option. RSAs, you can make that election, and it can be a significant tax benefit to you. There's no dividends with RSUs, and typically under RSAs, because again, you're receiving the shares at that point, you receive dividends. Voting rights, you get voting rights when shares are vested under RSUs. Under RSAs, it's when at grant, because you're receiving those. That's the big difference between RSUs and RSAs. Restricted stock units are, hey, you have shares that you are eligible to receive subject to a vesting period. RSAs are, hey, we're giving you these stock awards. Now you have the dividends and the voting rights and everything else going associated with that. So RSUs versus RSAs. So let's talk about RSU taxation. And this is an important element to understand, because a lot of people think, well, I'm going to receive these at vesting date. I'm going to hold them for 12 months so I can get capital gains tax treatment. That's not necessarily a bad idea, but I think understanding the tax elements of this might change a little bit of that decision making. So if you see on the bottom left-hand corner, you're seeing the grant date. So you receive these, let's say it was January 1st, 2024, and there's no tax due at the grant. When you receive those, your company will tell you, okay, great, here's how many shares you're eligible for. Here's when they vest or when they are actually delivered to you. And so the value of the shares when they vest. So even if it was granted to you at $100 a share, but when they vest, the shares are at $50. The ordinary income tax is what the value of the shares are at vesting. So when it vests, these will show up as ordinary income. Most cases, it's going to show up on your W-2 when you file your taxes the next year. And so at that point, all the shares that you receive are taxed as ordinary income. Now, you could say, look, I am now going to hang on to these shares and let the share continue to grow, the share price continue to grow. And so from the date of vesting, whatever the price of the stock was at that point, if it now is higher and you go to sell it, then that difference between the vesting value and the value at when you sell the shares, that's going to be taxed as capital gains. Now, if you hold it for less than 12 months from the vest date, not the grant date. So if you hold it for 12 months from the vesting date and then you sell it, it will be subject to long-term capital gains, usually 15 or 20%. If you hold it for less than 12 months, this gain from vesting date to the sell date is going to be taxed at short-term capital gains or your ordinary income rate. So one of the questions to ask yourself at vesting date is, if I got a bonus instead of shares, would I be willing to go out and buy the company stock on that date? Because that's effectively the decision you're making, right? The company said, hey, we're giving you a bonus, but instead of writing you a check, we're going to give you shares back here on the grant date. So let's say it was a 1-year vesting period. They said, hey, look, Joe employee, we're going to give you a $100,000 bonus. We're just going to give it all to you in shares on January 1, 2024. And then on January 1, 2025, that's when you're going to receive the shares or the bonus on whatever the value of those shares are on that date. And then you receive that bonus in shares and you get taxed on all of that. And then you can say, great, would I be willing to then invest that money into more company shares? If the answer is no, then what you should probably do is just sell all the shares that day, because all of this value has already been taxed at ordinary income and will be taxed at ordinary income. The only thing that then is subject to capital gains tax is the growth from the vest date to when you do decide to sell it. And oftentimes people are already over invested in their company if it's public, right? All your income comes from that. Your employment comes from that. And you may have stock in your 401k or personally have bought some on the open market. So you might be like, okay, well, maybe I'm over allocated to my company. And with these RSUs, maybe I should just sell them and broadly diversify myself into something else. So that's the decision you make on that vesting date is, hey, do I just want to receive the cash because it's already been taxed and then redeploy that? Or do I want to hang on to these shares because I think they're going to appreciate and be subject to capital gains on what the growth of those shares might be over the holding period? So an important element, important decision making in RSUs. Okay, let's briefly talk about an 83B election. It's a bit of a complex element, and if you are receiving any employee stock, RSUs, phantom stock, any of these things, you should talk to your tax professional and say, hey, am I eligible for this election? Because it can have significant tax implications. So really, it's a tax provision that gives an employee or startup founder the option to pay taxes on the total fair market value of the restricted stock at the time of granting. So again, remember, this does not apply to RSUs. This applies to RSAs and other types of stock awards, not RSUs. So this is a little bit different. We're switching gears from RSUs to RSAs or other types of employee ownership of a company's equity. And so let's go through a brief example. So the idea, this quote up here at the top kind of tells us what we're trying to do with the 83B. You're telling the IRS, tax me now while my stock is worth almost nothing, rather than later when it could be worth a lot more. So usually when founders or companies start, they issue shares at a very small price, right? So this grant date, you can see this is they're issuing the shares at 1/10 of a percent, 1/10 of 1 cent, right? And so that's very cheap. And so basically you're saying, hey, look, I want to be taxed. I want to pay the tax on all of these shares now while the stock is worth 1/10 of a cent versus in the future when these shares might be worth $2. Because when these shares vest, the IRS basically says, hey, as these things vest, and now you have ownership of the shares, we're now going to tax you at ordinary income rates when those shares vest. So if we look at this far right corner with the tax without 83B, and the assumption here is that this owner or founder is in the 37% federal tax rate, and that there's a 25% annual vesting. Right, so they receive 100,000 shares at 1/10 of a cent, and then 2 years later, 1 year later, 25% of the shares vest, and at that point, the shares are now worth 25 cents a share. In that scenario, the founder then, the IRS would say, you owe $23,000 in ordinary income tax. And then the second year, another 25% vest, and now the shares are worth 75 cents. Another $70,000 is due in terms of ordinary income tax. The third year, now the stock is at $1.25, pays another $115,000. And then the fourth year, when all the shares have vested, now the share is worth, the stock price is worth $2, the shares are worth $2, another $185,000. So over that 4-year vesting period, had the 83B election not been selected, they would have been subject to almost $400,000 of tax. Now, with the 83B election, and this is a complex, there's no form, you send a letter to the IRS saying, I'm making this election. It's something that needs to be coordinated with your tax professional and really evaluate where you think the stock is going. Because if the stock ultimately becomes worthless, then the 83B election may not make sense. But if we look at the 83B election, the founder is essentially saying, tax me on 100% of my shares at grant when I was granted the shares, and they would pay $370 in ordinary income tax. Now, to be clear, they don't avoid the capital gains tax. The difference between almost $0 to $2, that gain would be subject to capital gains tax, but a 15 or 20% tax is way better than a 37% ordinary income tax. So pretty powerful if you think about how to implement this in your scenario. The key thing here is just be aware that it's out there. And if you are getting something other than RSUs, if you're getting founder shares or stock awards or grants, it's worth exploring, hey, does this make sense for me to make this specific election? So now let's shift gears to some other elements, and these are a little more complex from a tax standpoint. They bring in alternative minimum tax considerations. But essentially, the key difference between ISOs and NSOs is that employees can receive both ISOs and NSOs, but only ISOs can be received by employees. And so that's kind of the big difference. These come with options. So it's not a stock award like RSUs and RSAs are. These are options, gives you the right, but not the obligation to exercise shares in your company. So there is going to be a cash outlay to exercise these. Now there's multiple options you have available to you when you do exercise. You don't actually have to write a check. You could use shares. You could exercise and sell at the same time. So a cashless exercise. So that's why I say the documents associated with the ISOs and NQSOs and RSUs that your company has drafted to explain how these things operate is important, because there is some flexibility in terms of how these can be offered to employees and how they are exercised. So really important to understand how these apply to your specific company. All right, so let's talk a little bit about some questions to ask before making a decision. The critical question is, what taxes will this decision create and when? Right? So you're like, okay, well, maybe I should exercise my ISOs or NSOs. And at what point, how much should I exercise, and what kind of tax impact will that have? RSUs, you don't have any flexibility, right? Once they vest, those awards are given to you, and then the ordinary income tax is calculated. And oftentimes, some of the shares can be held back to cover both the withholding and the potential tax associated with that. Another question you might want to ask is, how much of my net worth is already tied to my employer? And not just your net worth, your career, right? If something happens at your employer and you've got all your net worth tied up in the company and your job is associated with the company, it's kind of a double hit if something goes wrong at the employer. So this is really a question about, does it make sense to diversify away from the company using the stock awards or RSUs or options that are available to you? And then the other question, as you think about RSUs and the option that are available to you, is, would you buy that much company stock with cash today, just on the open market? Is this a good investment, is really the question. And then, do you need liquidity for taxes or other financial goals? Right. So if you're going to hold the shares and be locked up for a period of time, does that impact your liquidity and the ability to meet some of your other financial goals? And then, can the transaction be coordinated with other income, deductions, charitable giving, or retirement planning to minimize or lessen the impact that the tax impact that might occur from whatever your decision might be? And then lastly, what happens to your RSUs, your NSOs, ISOs if you leave, retire, or if the company is acquired? Understanding those change of control elements is really important to understand how these things might be valued or not valued if you leave, retire, or the company becomes acquired. So important decisions. I can't emphasize enough, get the company, the HR documents associated with whatever it is you have, RSUs, RSAs, ISOs, NSOs. Make sure you have a document that will explain a lot of these elements to you. And that's something that we request when we meet with clients, so we can better understand how to implement these and how to organize these within their overall financial plan. Okay, that was a brief overview. We like to keep these pretty short and tight so that we're not wasting our entire day, but just some things to think about. And what I would recommend is, if these things apply to you, is really reach out to us, reach out to your other professionals, and really start to have a conversation and model out what you have and how they might impact your overall financial situation. For us, the first step for us is our financial roadmap experience. So where we sit down with you and your significant other, really understand what it is you want your financial resources to do for you, what impact you want these resources to have on your life and on the people and causes you care about most. And then we talk about milestones. What are we trying to achieve with these? Whether it's retirement, buy a second home, have certain income, whatever it is. And then we benchmark your current financial reality, kind of see where you are and where you want to go, so you get more clarity about the decisions you need to make and how to organize your finances to make better financial decisions. This is a complimentary experience that we provide. It's 45 minutes. We can do it in our office preferably, but we can also do it over Teams or Zoom, and really help you get some clarity around your financial goals so that your finances are optimized and maximized to accomplish the things that matter most to you. Lastly, some resources. We have a great white paper called Understanding Your Employee Stock Options. If that's of interest to you, feel free to email us, put it in the chat below, and we'll get you a copy of that. But we've got a ton of resources, whether it's, hey, I need to focus on estate planning. I'm really trying to get a sense of, build out my net worth and get an inventory of all the assets and liabilities that I have. We've got a resource for that. So just reach out to us with whatever questions you have, and we can help align the resources to get your questions answered. Lastly, thank you for taking the time. Our view is time is our most valuable resource. We can't buy more of it. We can't create more of it. And so for you to spend some time with us today to get some additional insights on stock options and what we can provide and how we can be helpful to you, we appreciate your time today. And hopefully you found some value out of this. And we look forward to engaging with you in the future to help you make better financial decisions. Have a great day.